whether you're XYZ, whatever generation, business is still done by relationships and face-to-face.
100%.
You can't meet brokers over the phone.
Move over, baby boomers. It's time for Gen XYZ. It's time to stop waiting on the world to change. It's time to be the change. It's time to stop thinking about how your life can be better. It's time to start taking action, massive action to improve your life. Join Zach Winter and Mark Adair Rios every week as we learn how others had the grit, determination, and conviction to 10x their lives, and as we explore ways that can help you 10x your life.
Hi, and welcome to another edition of 10X for Gen XYZ podcast. I'm Zach Winter.
And I'm Mark Adair Rios.
And today I'm very happy to have as our special guest, Randy Langenderfer. Randy is the president of InvestArk Properties that specializes in multifamily investment properties. Randy, welcome to the show.
Thanks, Zach. Thanks, Mark. It's really a pleasure to be here this afternoon. I look forward to it.
Hey, Randy.
Yeah. Randy, maybe we can get started by having you tell us a little bit about your background and how you got into real estate.
I'm happy to do so, and thanks again for the opportunity. My journey started, I guess, back in about 2010-ish. Well, I guess it really started when my wife and I bought a condo in Myrtle Beach as a vacation home. When I learned that, it started out real early. I remember telling her that if, real estate was appreciating there 15, 20, 30% for the last 5 years. And I bought this condo and I said, if it appreciates just 6%, babes, I said, we're golden. This is golden. Well, then 2008 and 2009 came along.
Oh boy.
So I got the first introduction. But about 2010, I was living in the Cleveland, Ohio market. And I was working for a private equity company at the time. And if you know anything about private equity, those companies have a short window. They're really syndications is what they are. Mm-hmm. They buy companies, they re-engineer them, they improve their bottom line, their NOI, and they resell them. So I knew it wasn't a long-term gig, but I had a brother-in-law that came to me who was starting to flip houses, and he asked me to come alongside of him. So we became hard money lenders to a group out of South Florida. And we did many houses. It was successful, but my private equity gig was winding down, and I took a job in Houston, Texas. I work for a large academic medical center here in the governance arena. So I deal with a lot of risk management issues on a day-to-day professional basis. And at that time, I was trying to really develop a passive income stream. Mm-hmm. And I walked into a Lifestyles Unlimited meeting here in Houston, Texas, one of the large educational arms. I was there for a short time. I went to the Sumrock Group in Dallas, Texas. Brad Sumrock, you may have heard of him as well. Yes. And that's where I really cut my teeth on multifamily, and I started investing as a passive investor.
So just for our listeners, Lifestyle Unlimited and Brad Sumrock's group, both are educational coaching programs that teach people how to buy, is it primarily multifamily, and how to syndicate investments in multifamily?
Lifestyles will do both single family and multifamily. Sumrock will do just multifamily.
Yes.
Okay.
And I was there. I learned all about the team concept. I started to invest passively, being a limited partner. I wanted to learn the deal structure. And so I said, I'm going to learn by doing rather than textbook. And I found general partners that were willing to spend some time with me as an LP when I asked dumb questions, or what I thought was dumb questions about various aspects of it. And all of them are great organizations. Today, I'm part of Rod Khalif's mastermind. And so, the shout out for all three of those. There's plenty of other great ones for your listening audience. Michael Blank, Jake and Geno's, Mark Kent's, all do similar things and all have a very good track record. So I did my first GP in 2018, just added about 550 doors, 450 doors this year. And I'm having fun and enjoy what I do.
That's great.
That's terrific. So you started out on the LP side, invested with other general partners, syndications, learned along the way, and eventually you started acting as a GP in your own deals.
That's correct. And I went to those groups because I think they, specific at the time, I remember going to a Sumrock event and I said, gee, how do I find these deals? How do I find one to invest in? I'm new to this game. And I remember the guy going, just hang out here.
Yeah, that's really interesting, that the partnership concept and just this idea of scaling up. I always say this to people that I'm meeting out there, and whether it's networking or online, and they're asking me for advice. And I kind of let them know, you can do the monopoly way. You can do your creative financing and do your lease options and do one house at a time, even, go out and get a bank loan. But really, if you really want to grow and scale exponentially, you got to learn how to partner up with people that you trust, hopefully, to, number one, learn and realize that it's a big, wide, field. But number two, when you find the right combination of partners, things can really take off.
It takes off.
It takes off.
It takes off. And those ecosystems, any one of those groups will help exponentially bring that about. Whether you're, you can, if you just want to find LP deals to invest in, that's going to give you a better than return than you're going to get most likely in the stock market, any one of those groups. But you guys know there's tremendous amounts of meetups available today.
Yep.
Wherever you're at in the country. I was just talking to a potential investor yesterday, and he said, how do I plug in? I said, just Google real estate meetups, and you're going to find them in your area. And it's just a matter of how much time you want to spend traveling around your local market, or how far you want to travel, and how many you want to attend.
Yeah, that's right. Before COVID, we had virtually every night there was a different real estate related meetup somewhere in Los Angeles that you could go to and network and learn. It was really terrific. When COVID hit, a lot of that switched to Zoom, but at least in my experience, it's much more difficult to stay engaged and to network via Zoom on these types of meetups. So I'm looking forward to the day we can get back out there and start interacting with people again.
Well, so I'm a boomer, so I love face-to-face, right? I love face-to-face and voice and being able to read expressions. And yes, Zoom gives me a visual, but there's nothing like when the person's tapping their toes or tapping their foot to realize they're not listening to the yes. So yeah. I echo what you say, Zach.
It really is. There's a big component of that old, belly to belly kind of chatting.
When you just can't stay engaged like this for hours, or even, an extended period staring at a screen. Well, we've learned to adapt, but gosh, I was just at a mixer last night for the holidays, real estate one, and it was a lovely experience.
Yeah. That's great.
It
was fantastic.
Just like-minded people.
Yep. I've gone back to, I think, 3 in-person mixers so far since COVID, and it's really refreshing to get it back out there and meet people and see people and chat with people face to face.
Because no matter whether you're XYZ, whatever generation, business is still done by relationships and face to face.
100%.
You can't meet brokers over the phone. You can start there, but brokers, property owners, property managements, legal, all your key elements. Sooner or later, you're going to have to get out from behind the screen.
It's very true. It's very, very true.
So, Randy, you and I have a similar initial background in terms of how we got into real estate. You got into real estate as a hard money lender for people flipping single family homes. I got into real estate buying single family homes around the country and renting them out. And eventually I realized that my ability to 10x my real estate portfolio and the cash flow I was getting from real estate was really going to happen if I switched over to commercial real estate, right? Especially as an investor, because in commercial real estate, you're buying larger properties and the values are based off of the net operating income multiplied by a cap rate multiplier. So you can really force your appreciation through value add plays. Do you go through a similar process when you joined Lifestyles and decided to switch?
Yes, and so I'm a finance MBA CPA, so I get the number side of it, and I certainly embrace that. But the other that was the I mean, the simple illustration someone told me a long time ago is have a little bit in a lot. Have a little bit in a lot versus a lot in a little. I was meeting with, I mentioned this investor yesterday. He wants to do a 3 or 4-plex. I'm going, okay, but I said there's as much work in a 5-plex as there is in a 100-plex, right? In terms of due diligence and all the supporting services, and like you said, one of the reasons I got into real estate, the 10X, is I was a landlord very early in my life and realized I never just one, and to quote the real estate guys, I never want to deal with tenants, toilets, and termites again. So that's the beautiful part about, and the 10X, not only your money, but your time. I consider my time equally as important as return. So the value of multifamily is there's a lot of upfront work to get it going, but then it gets on autopilot, year 2, year 3. And the compounding factor, as you guys know, it's been a really good 8-10 year run in multifamily.
Yes, it has.
From a return perspective.
And it might even eke its way through, when all is said and done. It might just squeeze through the eye of the storm. I don't know.
Well, I'm bullish. I'm sure you guys are too. There's bears out there, but I'm bullish as well. We bought one a month ago, and outlandish and in terms of price, but I think 3 years from now we're going to be sit back and saying, I wish I'd have bought more.
So that brings up a really good question in terms of just your portfolio now. So how many doors do you have right now of multifamily as an active or even as an LP?
As an active, 250, 400, so just about 700 as an active GP. And then I think I'm around as an LP around 3,500, 4,000.
Oh, fantastic! So you're in a lot of syndications on the LP side.
And that's the beauty of learning from others, right?
Yeah.
Again, back to, I'm not the brightest crayon in the box, but I can model and emulate other people's success.
Yeah. And so so in terms of your active portfolio, if you're kind of looking out, what are your goals for the next, if things go in a perfect world, like where do you want to kind of see your portfolio go? Do you want to increase your active side? Do you want to slow it down a little bit and stay more on the LP side?
Call me, somebody says, why are you doing this? I said, well, high energy and low IQ. High energy and low IQ. Well, I just enjoy it, first of all. And so I would say I'm bullish on both. I want to continue to do both as long as I can. I think I will do LP investing because I just haven't, I'm a finance guy at heart, and I haven't found an asset class that I like better.
Yeah.
On your LP side, are you just doing multifamily, or are you diversifying into other property types?
I have just diversified during COVID into a couple other ones, self-storage, mobile home park, and actually another, it's a beautiful one I can talk about, Dave Zook's ATM fund.
Oh, wow. Oh, wow.
If you've ever heard of Dave Zook,
I have, yeah.
It's got a great success story.
And
we could talk about that. So, but primarily, and overall, I tell people that I have a very close friend, high net worth individual, and we were talking about him dipping his toes as an investor in some of my properties, and I was saying that the institution I work at, it has a $2 billion endowment fund, a lot of money, and from an asset allocation perspective, they allocate 15% of that $2 billion into real estate. So I was challenging my friend, even if you don't know this like this, you got to think about it from an asset allocation perspective. Some of your funds should be in hard assets. Maybe you like precious metals, but hard assets such as real estate, time and time again, even the big portfolios, the big players do that. And then there's, if you're a Gen, XYZ, whatever, You can get in as an LP. You can start by, the first one I did, I was so risk adverse. I did a trust fund. Me and two guys, three of us went together for a $50,000 investment
Nice.
because I was so chicken.
Nice. Well, you know, that actually brings up a really good point.
That was my idea of risk mitigation.
Well, and so there are people. This is the thing that we have conversations about all the time, because, you know, Zach has he has two children, and I don't have any children, but I'm in contact with my nieces and nephews who are really out there, and they're kind of taken by, especially crypto right now, and these meme stocks, and just, there's a real kind of speculative kind of gambling thing going on right now. That, not to be that uncle who's like, you know, being a fuddy-duddy about all of that stuff, but also kind of recognizing that it, in my opinion, it seems to be kind of the wrong way, and it's a way to get in trouble, right? A lot of these guys are playing around with, you know, options on Robinhood, and, like, you know, just getting in like so much debt, and like, what are you doing? And so you brought up the ATM fund, you brought up, you know, getting in at a smaller amount. Crowdfunding is basically what we do. And there are now ways that you can take $5,000, $1,000, and dip your toe in, even, you know, a little bit even more scaredy cat, just to try it out. And so getting into the ownership side of real estate as a passive investor doesn't have to be on a grand scale. You can work your way up to it. But like you said, I think I think it's very important to understand how hard assets work and have some money in it, and not just go all in on Shiba. You know?
The crypto is the one that, you know, crypto is the one that gets me, because I just don't understand it. Call me old fashioned. I just don't understand it. And so I haven't invested in it, but one of my partners is all in. He does real estate and crypto, and that's about it. And I'm like, wow. But, you know, it comes back to I mentioned I'm a coach at Rod Khleif's organization. So the new students I talk to and stuff, I just encourage them to really try and develop a plan. So, you know, just the topic of real estate is so broad. I mean, I think, again, I know when you guys got started, and I know when I got started, I was just overwhelmed. Do I do single family, or do I multifamily? Single family, there's flip, there's hold, there's notes, there's just many different subsections within single family, and on multifamily, there's the same thing. It can be LP, it can be GP, it can be property management. You can go big units, small units. But for those that are X and Y's and Z's, I mean, the hope I can give you is just a consistent, long-term investment strategy. Keep your eye on the end of just consistency. You're not going to have home runs every investment. I can talk about that too. But, you know, if you consistently get singles, doubles, and occasionally throw in a triple or home run over an extended period of time, you're going to be just fine.
Yeah.
Ups and downs in markets and everything.
Yeah. Real estate it's really not a get rich quick game, but it's something that if you stick with it over the long term, it can lead to financial independence and long-term wealth generation. But you do have to stick with it. It's not like a meme stock where you invest today and hope a week from now you're going to be able to cash out.
And I haven't heard of it. Maybe there are. I'm sure there are someplace, but I haven't heard of any billionaires yet from crypto. But I know a lot. I can tell you 4 or 5 billionaires off the top of my head, you know, that made their fortunes in real estate.
Yeah, absolutely. I think a lot of the there's a thing with, you know, with flexing too much about being very rich, very, very rich because of crypto, right? Because they get targeted. That's true. And it's a wild, wild west in a lot of ways, because there's really no tracking that. But you know, on the billionaire side, I'm sure that there's I actually just saw a story of some guy in Australia. He actually just won a lawsuit Did you read this, Zach? He won a
Yeah,
lawsuit.
I did. It was a guy in Australia was claiming to be the real Satoshi Nakamoto, and he was sued by somebody by the estate of somebody who was supposedly his partner in creating Bitcoin. And he was being sued for something like $57 billion. And the jury awarded the plaintiff, I think, $100 million. And he was happy about that because it was like less than what they had offered during arbitration. So I don't know if there's a lot of skepticism in the crypto world about whether he's really Satoshi Nakamoto or not.
But there was also something I was reading that said that he had so much Bitcoin from early on, when it was $1, $2, that now it's worth 50 billion or something like that.
Yeah, even if he isn't Satoshi, he must have just a crap load of Bitcoin to be happy about $100 million against him.
I can't relate. Maybe you guys can, but I can't.
So you mentioned that you have some kids.
I do.
You mentioned that they're millennials, right? They're of millennial age. And have they kind of gotten into the business, as it were, or how are you approaching that?
I actually have 4 children, 3 grown daughters out of the house, and a 20-year-old son that's still with us. So the short answer is no. The long answer is dad is they're younger in their careers, and they're I only wish that I'd have started in real estate a whole lot earlier than I did. Well, but I also understood at the time I was a single earner and I had 3 kids and I was feeding babies mouths and stuff like that. So it was a different point in time. And so the point of it is, again, it's back to that journey. My children have not. I got my one daughter and invested in one LP opportunity, and I keep trying to spoon feed her and her husband about coming alongside of me and doing this. And that's for you, Dad. I don't, because a dad does it.
Yeah, I can relate.
If Dad does it, it's got to be weird. It doesn't matter how successful or failure he is. It's got to be weird.
Right.
But I am confident over time. I've told him the one I know is millennial, late 30s, and I said, okay, but after you spend about another 5 years in the corporate world and you get fed up and you get pushed around and you get, you get a 2% raise and for 150% work, and you get somebody that you can't get along with, you may consider it more in that future.
Totally. Yeah, I'd say about 60% of our investors in our pool come from a corporate background who at some point just kind of turned around and said, well, what are we doing?
What am I doing? The ladder's leaning on the wrong wall.
Right.
That's right.
When I think COVID has just exponentially, propelled this movement forward. People are saying, I can do this at home. I can do it on my own, and gee, I'm to start with, I may not need the big 6-figure income that I have already or whatever it is.
Right.
So I think COVID has really propelled this whole industry. I mean, I've been in, like I said, 2014, the number of educational meetups, podcasts, it's just amazing. And then you get out on the social media, the LinkedIns and the Facebooks, and you see the amount of people doing multifamily today. And I've come to the conclusion that that's good because it's a very fragmented industry.
Yeah.
There is nobody that dominates it nationally, at least to my knowledge. People may dominate. I spoke to a gentleman that had 2,000 units in Orlando. So he pretty much owns Orlando. At least there's nothing that's bought or sold that he doesn't have an opportunity to look at. But that's rare.
Yeah.
In Houston, there's some big syndicators that I know that have several thousand doors. But so again, encouragement to the audience that you can do this. You can do this while you're working. I'm still working. You can do this while you're working. You get started. Slow and steady wins the race. And just continue to learn and invest.
Yeah. That's great.
It can be successful.
That's really great.
Yeah. Well, I'd love to hear more about what you do as a coach with the Rod Khleif program when you're working with the people that you're coaching. Do you set goals for them, and how does all of that work?
Well, I'm glad you kind of asked that, because first of all, I said I really do enjoy that, and it's fun. But you get, I'll say, all types. Primarily they went to a boot camp of rods, and they're excited and they want to charge forward, and so they're long on energy and short on everything else. And there's some that think that as a coach, that I'm going to give them a 10-step process and voila, they'll be a millionaire. And so that's the first thing I try to downplay, is there's not a 10-step process. There is a repeatable process, but it may look very different for you than it did the last person I talked to. And so I'm real big on goals, that very first thing. So, what do you want to do? And so I remember one of the stories I had, guy to go through this first planning session with a student. Okay, so what do you want to do? Well, I want to make $100,000 a year. Okay, that's noble. That's good. Well, how much assets do you have? How much assets do you have? Maybe $60,000, $70,000. Okay. How much? He's got a W-2 job. How much are you making your job? About 80,000. So that one is kind of like, well, okay. So you have to start with that point. I was trying to encourage him. You just have to start with a different focus. You don't have hundreds of thousands of dollars to invest. This is a capital intensive game, as you guys know. Right. So you can do it, but you have to start partnering with other people. Maybe it's in a crowdfunding example, or maybe it's in a partnership to buy one share of a syndication and learn it, and et cetera. So it's just prioritizing those goals of what do they really want to do. And then, I had one student that was actually from the City of Angels, where you guys are at, and she was independently wealthy, and she needed me for about 2 sessions.
That was it. She was off to the races.
Boom. She was off. She had a lot of resources in her back pocket, and she just needed some connections, and I was happy to provide her what I know. And the last I knew with her, she was in Vegas buying multifamilies within less than probably 9 months.
Wow.
And not just 5 doors, probably 100 units to 150 units.
So in that program, not to kind of, get into the nuts and bolts of it, but do they teach the idea of kind of leveraging like from the get-go, syndicating and stuff like that, or do they teach you to try to target small, what you can do within your own capabilities? Or
yeah, I think they provide the venue for both. Mm-hmm. At least I was familiar with Sunrock and Lifestyles here in Houston too, and both of them will kind of go at your own pace. So yes, there's today all those organizations again have a plethora of resources of how-tos, right? Mm-hmm, mm-hmm. How to build a team, how to find an attorney, how to find partners, and here's the checklist for partners you want to look at, and here's the due diligence checklist, and here's the lending things you want to look at. And so I think it's I go back to this fresh conversation I had with this physician yesterday, who's a high net worth guy, and he's probably 40, and I don't know what his net worth is, but I'm sure it's not. He's not poor, but I kept trying to get him off this mindset of 3-4 units. Why not just partner with somebody and buy 100 unit?
Right.
He didn't want to give away. He didn't want to give away the beans.
I don't know if it's a controller. He just wanted to educate himself first. Okay. And I think some of that is he just wants to educate himself first and then jump to something bigger. Right. I said, well, I'll help you however I can. But I said, you're going to quickly find out after you do 2 5 units or 2 10 units. The biggest thing I was trying to coach him on there, how are you going to do property management? You can do this yourself. You can hire somebody. If you hire somebody, you can be paying an arm and a leg. Blah, blah, blah. So, but I think the coaching experiences, I really would encourage whoever, and it doesn't have to be a formal coach. I've had lots of mentors in my professional career that have advised me. You can find, there's a ton of underwriting examples out on the internet today that you can go out and find templates, tools, and learn to underwrite if you want to. Mm-hmm. So it's really back to me, that goal setting. How quick, how fast, mm-hmm. How much money do you want to make? If you want to make $100,000, if you want to have $100,000 take home in this example the student gave me in like 3 years, okay, that's going to be aggressive, not totally impossible, but I would say the probability of that is not as equal as you could be making $20,000 a year,
right,
or something like that.
Well, and the interesting, Zach's point is well taken, right? That it's a kind of a long-term type of thing. And what I come back to at least is, okay, I have a goal of having making $100,000 in 3 years. Knowing real estate, really the opportunities for me to make that are going to be when there's a sale, there's some sort of sale or something. I mean, that's really because the ongoing
back
cash
end
flow,
gain.
the ongoing cash flow is fantastic, but it's going to take a long time to acquire, in this market especially, to acquire the properties that I need to get the distributions to be able to have a cash flow, that's $10,000 a month.
Yeah, I mean, just do the simple math. Say your average cash flow is 9%, which is kind of aggressive, right? How much you divide that by 100,000? That's what it takes to get $100,000 income at 9% every year. So that's a lot. I'm not there yet. On a cash flow basis, you're right, and that's why that's the other beautiful thing about multifamily is I learned that they're all agency loans at best or bridge loans today. So they're there's going to always be turnover.
Yes.
These very, very seldom does somebody hold a complex for 20 years or even 15, right? Because of what you said, investors want their return, want their money. So this isn't like a lifetime investment for anybody.
Yeah. Yeah. And again, in this market, it's so, I don't want to use the word frothy, but it's so exciting. I guess that's a good word for it right now. It's very exciting that people are actually reevaluating their 5-year plans and going, what's to stop us from exiting now? We hit everything we need to hit. We're 3 years in, or let's go, and it's interesting. It gets even more interesting talking about, 1031ing that and kind of cascading up into,
have you, I don't know if I'm allowed to ask you questions, but have you 1031?
Oh man.
Not yet, but that is one of our strategies, cascading up through a 1031 exchange into a larger property and a larger property after that.
We actually we have a property that we were very close to, putting on the market, and we were on the hunt for an upleg for the 1031 property. And, listen, the exact market that we're selling into, right? And the reasons why we're getting the profits in the first place, we would have to buy into that market. And so we made the strategic decision, because we weren't quite done with our value add plan, to continue on with that plan, build more value, and reapproach it, and so that's what we're going to do. But we definitely have the plan to 1031 that property, and perhaps, 1 or 2 of our other ones.
Those are what you call first world problems.
Oh man.
Right. Good problem.
I feel you, and I understand what you're doing, but that's a blessing as well. Absolutely. As you guys have done it. Congratulations to you guys.
Yeah.
Well, there's a lot of people with that same thing. That's why I'm invested in one as an LP that I think we're approaching the end of year 3, and I think I've got like 80% of my money back already. Mm-hmm. And the sponsors are wanting to sell it, and I'm saying, please don't sell this.
Right.
This is not going to go down in value, and it's cash flowing beautifully.
More and more of our investors have a similar mindset. They don't want a 3 to 5 year hold. They want like a 10-year hold, because they're getting nice cash flow.
Yeah. And you didn't get into that investment because you needed the money next year. It's a long-term investment, and I'm trying to just convince this, but syndicators, we know the mindset. They can say they've tripled people's money in 3 years, and that's a great thing.
Yeah. Well, and listen, there's something to be said, with this whole kind of theme of what we do here is 10xing as an active GP. When you really think about it, and hopefully you can be cash flow positive, so you don't have to have that as a consideration when you're trying to think about selling a deal. But when you actually step into your basis as, the sweat equity, as it were, and then contemplate cascading that into another deal tax-free, you really start. That's for me. When Zach explained that to me, when we sat down with our CPA and really kind of got that, that's when real estate took off in my mind. I mean, really, really took off in my mind. Like, wow, this thing could really, really grow to something beyond what I thought it was,
Yeah.
So.
And it's only hope the legislators don't remove that 1031.
They keep threatening to, but
I think we're clear for at least another year. But who knows?
I think so. I think they decided to push that billionaire tax instead.
Yeah.
Oh man.
That's just crazy too, but it's still a wonderful time to be in this industry. And, if I talk to other students and talk about, man, is this, prices are so high. And, but I say, I guess I'm just of the opinion that to continue to buy and sell in every market, up, down, and sideways, you're just going to buy differently.
Right.
You're going to buy differently in a down market or a flat market. Because back to that primary assumption that these are real assets that over a long 10-year period or whatever period you're looking at, generally speaking, they're going to rise in value.
Right.
They may have short-term blips like we saw in 8 and 9, but they've come roaring back faster than the market has.
Right.
Yeah, that's right. That's right. I mean, I was buying single family homes when I first got into real estate in the late 90s. And when the market crashed, I sold most of my stuff. I was in real estate. I saw the market was peaking, and so I exited. But I held a few of them, and they definitely went down in value, but they more than recovered. I sold one of my last ones in St. George, Utah, single family home, and considering it was like a 20% down payment, the return was phenomenal. I mean, that home probably doubled in value after you rode through the Great Recession. So,
and what a beautiful thing.
Yeah.
I'll tell you, man, I got to say, and I'm with you, Randy, like Zach, I don't know how you do the landlord thing. I did it. I did some flips. I did a lot of wholesaling. When I first got in, I really wanted to do everything before I got into commercial. And, I'm a mortgage lender, I'm licensed and all of that stuff.
Okay.
But the one thing that I was truly, truly horrible at was actually landlording. I was so bad that I would never, I had such a seminar. I was like, I'm done. Really, honestly. And,
well, but those are, but Mark, I don't know the experience, but it sounds like, and I have a few similar stories, but the immense growth that you find, and that those perceived failure forward help you define your strategy better today and clearer,
100%,
right?
100%. Talk about when I said, that there were particular times that I wanted to exponentially, there was a decision that was one of those moments where it was like, I'm done. I'm selling my portfolio. I'm going into commercial. I'm going all in with it. And, I haven't looked back actually, once I did that. So.
And I think that's part of the educational process, because there's such a wide universe of quote under the commercial real estate umbrella or the single families that, that's why I keep going back to define a strategy and stick to it. I see the students that, they're chasing what I call the shiny object syndrome, right? Somebody offered me a 20% IRR or a 30% IRR or a 10% cash on cash, but what do they know about it? Or what do you know about it?
Right.
Yeah.
And that becomes, in my mind, speculation versus investing.
Yes.
An investor knows the business risk, understands them and the mitigating factors, and they put their investment in because there's a business plan there to address those versus, oh, I like Mark and Zach, here's $50,000.
Right. Or this IRR on this property in Hodunk, wherever, has a great IRR. I know nothing about the geographic area and the market, but it's got a great IRR.
Yeah, it's in Podunk, Utah, or Podunk, Ohio, whatever. And You're right. You're like,
you got a hotel in Midland, Texas. Here we go.
El Paso, yes, some of those cities out there in West Texas, yes. And that doesn't. If your listeners have invested in those, my first investment was in Beaumont, Texas, and everybody told me to avoid it. It's about 150 miles just due east of Houston, right on near the Gulf, and it's a lovely working community. But my point of it is, maybe if you know Podunk, Ohio really well, and you understand the business risk going back to investing, okay. And we studied and educated and found out all about Beaumont, Texas, and looked at a bunch of different assets, and we were quite successful. But it was a lot of work, and from a probability standpoint, I tell people, you want to start with high income and high growth areas.
Right.
That's why everybody's coming to the Southwest and the Southeast. It's because those regions of the world are growing. Jobs and income, and there's a higher probability of success.
Right. Yeah, we start at the macro level too. We, have a number of different factors that we look at specific marketplaces, and we don't look at specific properties until we've identified the marketplace, and we want to target that market and that neighborhood, and then we'll look at what properties might become available in that area.
So hard. I'll tell you, that was one of the readjusting the mindset on that thing, because I had the same thing where I had gone to a couple of, big kind of guru. I was actually part of the Sumrock a group, and also a gentleman named Dave Lindahl, who had a pretty big.
Yeah, he was huge.
Yeah. And, that I'm not saying that those programs taught me this, but we have access to everything on the internet, right? And so it's so easy to just go out and look at properties and start fantasizing and going off, and all of a sudden you're jumping all over the country, looking at all like a rabbit, right? You're jumping all over, taking a look at property here, and there's a 26 unit over here in Peoria, and check out this little place in Alabama. I could buy this, and it really. There's a certain amount of discipline that needs to happen to kind of really curtail that kind of, because what I also realize, and this goes back to the goals too, is reflecting on that's just one of those little things that, like you said, shiny objects that slow you down. They slow you down, and it's a form of procrastination in a weird way, right? The courses and the jumping ahead and trying to find deals and spending your time chasing after these things and chasing over here. And
they're eye candy. They're eye candy especially to the investor who, thinks return. And that published return. And we all know that anybody can put out a spreadsheet showing a 5X return or a 2X return, but that means nothing unless they have a history. And so back to I'm sure you guys I get multiple opportunities to invest as an LP with the market the way it is. And to your point is, if you send me something in Kansas, I'm sure you're a great person. It's a great asset, but I'm not going to invest in Kansas. And no disrespect to anybody that lives in Kansas. I just don't know it. It's not that it's a bad market, but I'm not going there.
I actually just had a gentleman wanted me to invest in the bank. They're starting a bank and they're raising capital for it. And I was like, okay, it's not really in my wheelhouse. They are, but he said we have 6 million raised so far. It's like, you guys got a long way to go. You want to start a bank
for a bank? That sounds like a drop in the bucket, but I'm sorry.
I mean, that's going to be your first commercial loan, your first multifamily.
Wow.
Some places 10 units.
But that's back to the example of hone your strategy and the shiny objects. And I'm sure they were promising a very healthy, hefty return.
Yeah, I didn't even really get into it, but I had to really just let them know it's just not my wheel. I don't know anything about it. I couldn't tell you whether or not I wanted to be an owner in a bank. Sounds cool. I just don't.
Yeah. And when those opportunities come across my desk, I just say, my time employed, family, and what I'm doing is very limited. So I'm sticking to a very defined investment strategy. It's multifamily in 3 or 4 markets with 5 or 6 sponsors.
I like it. I like it.
And that's my LP strategy. And then on the GP side, we're focused on, Houston, San Antonio, and I was looking at Phoenix, but it's so super hot right now. I was looking at that pre-COVID and made several exploratory trips there. But for all the numbers reasons that we just talked about, high income, high population growth, that's why the numbers are just off the charts there, and there seems to be no end in sight.
Yeah.
Randy, I'd love to hear what are some of the things as a limited partner in syndications. What are some of the things that you see that you like general partners doing, and what are some of the things that you don't like that you think they could improve upon? Whether it's communication or whatever it may be.
Well, top of mind, I may turn off some of your audience. I don't know. Back to the strategy, though. So as you asked that question, the first and foremost thing that I'm sure you've heard the illustration of the horse and the jockey, right? What's more important in a horse race, the horse or the jockey? And in the multifamily, what's more important, the sponsor or the asset? Whatever, is it Mark and Zach, or is it they're looking in Houston, Texas, and this asset, they know Houston, Texas really well? Well, for me, it's the sponsor. And I think you probably agree. It's the relationship that I have with several of them over a period of years. So first, the relationship. Second thing, as an LP, I look at is kind of, there are disputed, other people disagree with me on this. So I've heard several prominent investors say they will not invest in an LP unless there's a preferred return offer. They will not invest as an LP unless there's a preferred return offered. I would respectfully decline that. I don't have that passion. I actually, with some of the capital stacks coming out with the multiple capital stacks, and I see GPs that aren't getting any money for 3, 4, maybe 5 years until the back end sale. I prefer, as an investor, as an LP, the simplistic model, the 80-20 straight split, because I want my general partners being compensated. Me, I don't like working for free for 3 or 4 years,
right?
Even though there may be a big back end. So it's the sponsor, it's the capital stack. It's, do I know the markets? So you want to have some comfort in the markets, or an extreme comfort in the sponsor. Now, I will tell you, I've done both. When I first started, no, I wouldn't invest in a property unless I could get to it, drive it, touch it, look at it, seek it, shop it. I don't do that as much anymore unless it's in my immediate Houston neighborhood. But I have a lot of comfort in 3 or 4 sponsors I've worked with. So that goes back to that. But so if they bring me a deal in Topeka, Kansas, I might look at it. Well, okay, let me give you the example of that. One of my favorite sponsors is growing in Cleveland, Ohio. I came from Cleveland, Ohio. I know that market very well. I have not invested anything in his Cleveland operations. I'm not as bullish
because you know the market.
I'm not as bullish on Cleveland, Ohio as he is.
Right.
He'll probably be successful and return some very nice returns. So I think it's the sponsor. I think it's the capital stack. I think it's the asset where it's at. And then the other thing I always look at is, is it an investor friendly deal or a sponsor friendly deal? And so what I mean by that is, as an LP, is there somebody taking a 70-30 split with an asset management fee, an acquisition fee, a refinance fee, a liquidation fee, and a waterfall in the back end?
Right.
And I'm not disparaging those types of those opportunities, but that's just not my investing model. I think those are what I would call very sponsor friendly deals. Again, I prefer the very simplistic 80-20 capital stack. Everybody shares, gets paid along the way. And if they do their job in the back end, we're all going to make nice money. So I'm really attracted as an LP investor to those that I think are investor friendly models.
And what about, we talked about the pref. What about skin in the game? I'm sure you.
Oh, absolutely. I'm sorry. Absolutely, Zach. I missed that one. I forgot that one. Yes. And then the question becomes is define your skin, because there are a lot of syndicators who are just rolling their acquisition fee into the deal and really don't have any cash in it.
Right.
They really don't have because they had upfront money, risk capital, and they would say they had risk capital, but they get that back at closing, and then after the deal. So yes, I always ask, do you have any skin in the game besides the acquisition fee, and if so, how much?
Yeah.
Nice.
Yeah, I think it's important because you want your sponsors to be in alignment with you and to have some skin in the game, something at risk, and then also some, they're aligned with your interests because they've invested in the deal. They're also going to profit as you profit as a limited partner.
I had a conversation, the GP deal I just did with a high net worth individual who, like I said, a good friend, and he was putting in 250, I was putting in 100, and I said, I respectfully, my 100 is probably proportionally more than your 250, just because he could lose 250 multiple times.
Right.
It'd be a world of hurt for me.
Right.
Yeah.
But
well, I guess that's kind of what it comes down to is, at least from my perspective, the amount doesn't necessarily have to be a hard number. I think it just needs to be something that, like Zach said, aligns interests with the investors and is at stake. If things go bad, is it going to motivate them because it's going to hurt if they lose their money? Is it going to motivate them to really find ways to make sure the deal survives?
And as a GP, I just had this conversation. As I said, we were projecting a 2x return in 3 years. And I said, the logic is there. You can call it aggressive, but the logic is there. I underwritten it. I'm a finance guy. I believe it. But I said, really, even if it's wrong and I return 1.8 or 1.9 in 3 years, are you going to be angry? And to the fact that I've invested my 100K right alongside of you. So to your point, I'm committed to those estimates, those pro formas, and I have my money on the line as well. So I have a hard time looking investor. I'd have a hard time looking an investor in the eye and say, do this if I didn't have my own money in it.
Right.
I mean, just would feel real uncomfortable doing that.
So you mentioned earlier that you're kind of diversifying into some other asset classes, and I'd love to just hear a little bit about any of the uncomfortableness that you kind of experienced, kind of spreading your wings a little bit, especially the ATM deal. Like, did you kind of have a little bit of I don't want to say setback, but maybe you took a step back and tried to kind of reorient yourself because it's out of your comfort zone?
Well, one, I said that I'm all into real estate. I have, and I guess this was a COVID revelation when I had time to sit around and think about it. I probably got 35% of my net worth in real estate. Mm-hmm. And I'm all in for that, but I probably should have a little diversification. And so learned that, that what are of the commercial real estate classes, what are the best performing assets in a downturn? And what I was told is the number one best performing asset class in a downturn is mobile home parks.
Oh, wow.
Number two is self-storage. And number three is multifamily. And in the 8 and 9 crisis, multifamily was hit. I forget if it was 5 or 10%. So those other two asset classes did even better. And that was really the logic that I went to from a diversification strategy of saying, if you think the bottom's falling out or going to fall out, you should have a little bit of hedge against that there. And then the ATM fund I have met Dave Zook a long time ago when I was in Ohio. He's based out of Pennsylvania. and I'd just forgotten about him and was listening to a podcast and he was talking about it. And so, it's not a 2x or a 3x multiple, but from a cash flow perspective, and that's what I was looking for at that time. I'm diversifying my portfolio and emphasizing cash flow at the time.
Mm-hmm.
And I still emphasize that. I still like the 2x or 3x on the back end, but I as a passive investor really want to see cash flow day one. I don't want to wait 2 years for it.
Right.
And that ATM was, again, as an investor, shiny object syndrome. I'm gonna get the documents, so I'm getting the PPMs, I'm getting the pitch deck, I'm reading it. Another thing an LP should do, I forgot, Zach.
Yeah.
Read the documents, read the PPM, read the OM, ask questions. I failed to mention that one. So that's what I did on this. And I asked for it. Can you give me 2 or 3 references? I want to talk to somebody that's invested. I've never had anybody ask me that as a general partner yet. I'm happy to do so and can do that. But so it's doing your own personal due diligence. Right. And I'm happy to say I'm a year into it and it's doing just fine.
That's terrific.
Yeah, I would imagine that the transaction fees are really kind of drive that, right?
When was the last time either one of you took an ATM? But what kind of sold me on the ATM concept is I walked into my local, it wasn't Whole Foods, but it's an equivalent of Whole Foods in my area of Houston, locally owned. And there, as the exit, I was walking out, there's an ATM machine. And then, you never think of these things. And I go into the local convenience store, there's an ATM machine. You go into the Walmart machine, there's the Walmart store, there's a local ATM there. Yeah. And I call it the poor man's tax because they'll spend $3 or $5 to cash a $50 check at an ATM.
Yeah. Or get $20 out.
Or spend $5 or $3 to get $20 out. It's a fee on the back end, but and so those things are extremely fee laden.
Yeah.
But they sell the convenience factor, and they are just a cash cow for the owners of them.
Interesting.
They're connected to a bank network, so it's the fraud risk is very low. I guess the biggest risk we see here in Houston is there's some people that on the outdoor ATMs as they drive up and they'll pull the whole machine away with a pickup truck and a chain.
Yeah, I've seen videos of that on YouTube.
Dragging it down the street, which is crazy. But anyhow,
if they catch it at late at night, it doesn't have any money in it. So
yeah, jokes on them. Jokes on them.
That's funny.
Wow.
It's all good stuff though, but I guess back to the story of develop a strategy, long-term, keep investing, look for solid business partners, general partners, and just continue to educate yourself. I mean, I've been doing this now for 7-8 years on the multifamily side. And my wife, when we get in the car now, she says, Randy, do we have to listen to another real estate podcast? Can we listen to something else? Oh, okay, babes.
I got this ATM cash flow podcast that I want to listen.
Right. We're really going to mix it up now.
But the point of it is the learning curve never stops. Is what I'm trying to say to the audience and someone listening up way is the learning curve should never stop on your investment strategies.
Yeah, you got to be a constant learner, right? That's a Charlie Munger lesson. Lifelong learner.
There you go, a lifelong learner, and you build on your education. So,
yeah. Well, this has been terrific, Randy. Thank you so much for coming on the podcast.
Yeah, it's been fantastic, Randy. Thank you so much.
Well, it's been my pleasure, guys.
Tell our listeners how they can find out more about you.
Thanks. And I want to echo, it's really been enjoyable conversation. Some of these I get on where there's a defined script. I really enjoy the free flow conversation. But if anybody wants to reach out, I'd love to speak with them, either if they have an interest in investing or education. Like I said, I truly enjoy helping people. A lot of people have built into my journey. So the easiest way is my webpage is invest-ark invest-ark.com. There's a contact page on there. Make a Calendly, and we can schedule a time and love to chat with you, whether it's 5 minutes or longer, and get to know you. And if there's any, it's all about team and networking. So, as you guys know as well, but I've really enjoyed being on your show, guys.
Yeah, thank you, Randy. And we'll be sure to include a link to your website in our show notes.
Yeah, totally.
Fantastic.
All right, thanks. Bye.
My pleasure.
Bye, everybody.
10X for Gen XYZ is hosted by Zach Winter and Mark Adair Rios, co-founders of Prosperity CRE, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and building long-term wealth. If you like the podcast, please give us a positive rating and subscribe to be notified about future content. Also, if you'd like to learn more about our approach to real estate investing, you can download a free copy of our real estate investment book, Investing for Cash Flow and Long-Term Wealth, by clicking the link in the show notes below. Thank you, and stay tuned for our upcoming episodes.